Welcome back to New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're the owners of Property Apprentice, and we're here to help you navigate the New Zealand property market with facts, not just headlines.
Today, we're opening up with episode 11 with some very positive news about the home ownership dream in New Zealand. New census data shows that our housing mix is fundamentally changing in some key areas thanks to a decade of intensified building.
We'll also be tackling a major regulatory update that came into effect on April the 16th. These are the new rules for managing methamphetamine contamination in rental homes. This is a massive shift, and we're going to spend some time today making sure that you understand the testing thresholds and your legal responsibilities.
Then finally, we're looking at the latest migration and tourism data, with net migration running faster than the Reserve Bank expected. We need to discuss what this means for housing demand and the path of mortgage rates.
It's an episode packed with policy shifts and practical compliance advice, so let's dive in. We're kicking off with a deep dive into the new build corridors across the country. For years, we've talked about the construction boom, but we're finally seeing the data prove that owner-occupiers are moving into areas that were previously dominated by rentals. Suburbs that were renter-heavy are seeing sharp rises in home ownership as new developments come on stream. Suburbs that were renter-heavy are seeing sharp rises in home ownership as new developments come on stream. Suburbs like Penrose in Auckland, Ruakura in Hamilton, and Wharewaka in Taupo are leading this charge.
So the facts are census data shows us intensified construction is changing neighbourhood demographics. In many high-growth suburbs, renting households are giving way to owner-occupiers. Simplicity Chief Economist Shamabeel Equa noted that more homes are being built, it directly enabling more people to get into home ownership. Kiwis House Price Index indicates national values remain at 21.6% above March 2020 levels, but have eased 0.4% over the last year, pointing to a much more balanced market. The key driver for this is LVR, loan-to-value ratio, exemption for new builds. CoreLogic's Kelvin Davidson highlighted that townhouses similar to new products are attractive, especially because they allow buyers to work around those traditional deposit constraints. Suburbs like Hobsonville in Auckland and Marshland in Christchurch have seen their renting share fall while the number of homes climbed. Conversely, areas like Stonefields and Queenstown's Lakes Hayes remain critical rental hotspots.
So it's great to see that building more houses actually works. And Shamabeel Equa made the point that when we build more people own. That's a win for New Zealand society. It really is. And the whole point of this is that it comes down to supply and demand. When there's higher supply and demand is stable, prices come down to a point where it's a lot more affordable. So the secret weapon in this whole story is that LVR exemption for new builds. Don't let a 20% deposit requirement on an existing home stop you. If you can enter a new build corridor like Wharewaka, for example, with a smaller deposit, you're in the game much earlier. But also don't forget that banks are also allowed to lend to home buyers with less than 20% deposit, even if it's not a new build.
Exactly. And Kelvin Davidson hit the nail on the head regarding the home ownership dream. Even in a softer market, the push to own is strong. It's also interesting to see that as these areas mature, it can release other stock back into the rental pool, keeping the whole ecosystem moving.
That's right, because as people upgrade their homes and move into more affluent areas, as their financial position strengthens, then those other properties, it could become first home buyer market for the next generation, or as Paul said, rental properties for people who are looking for most affordable housing. Investors should not be put off by these stats. While some areas are seeing more owner-occupiers, places like Lake Hayes and Queenstown are still hunting grounds for rental demand. Although you've got to look at the rental return in areas like that as well, because Queenstown's not cheap. It highlights why you need to be selective. In this balanced market, committed buyers have got more leverage and time to make slower, smarter decisions about where to buy.
Segment 2, new meth contamination regulations. Our second segment today is a critical compliance update. As of April 16th, the Residential Tenancies Managing Methamphetamine Contamination Regulations 2026 are now officially in force. We will be linking the full source of the document in this description for you to review.
Methamphetamine is a Class A controlled drug, and the residue it leaves behind can make a property unfit for human habitation. These new rules finally provide the consistent testing standards and clear thresholds that landlords have been asking for. So let's have a look at the facts. A property is considered to be contaminated if meth residue levels exceed 15 micrograms per 100 centimetres squared. Decontamination must bring levels back to or below this 15 microgram limit. However, if levels exceed 30 micrograms per 100 square centimetres, the property is legally deemed to be uninhabitable.
And this is a massive change from what we previously have. If any of you remember, it was 0.5, I think.
There
Was
were
the
different
previous.
rules for insurance and different rules
And
for tenancy.
0.5 is just so low. So at least we've got that standard 15 now. The contamination is now assessed room by room. If the bedroom's contaminated, but the kitchen is not, only the bedroom requires decontamination.
That's a significant change as
Yeah.
well, isn't it? Because previously, if a room tested positive, you pretty much had to decontaminate the whole house.
So if a property is uninhabitable over 30 micrograms, landlords can give 7 days notice and tenants can give just 2 days notice to end the tenancy, provided that they aren't at fault.
If the uninhabitable area is physically separate and can be closed off without affecting the rest of the home, the tenancy cannot be immediately ended. Instead, the rent must be reduced.
There's 2 levels of testing. Screening assessment detects presence and can be done by anyone, but detailed testing confirms the amount and location and must be done by a qualified professional. Landlords must not knowingly rent out a contaminated property. They are required to arrange detailed testing if notified by the police, council, or if screening shows contamination. Light fittings and heaters must be cleaned. Soft furnishings provided by the landlord, like carpets and curtains, must be HEPA vacuumed and steam cleaned. However, items that cannot be cleaned, such as mattresses, couches, must be removed and replaced. Landlords must notify all tenants of testing within 7 days. Failure to meet these obligations can lead to exemplary charges, damages of up to $7,200 or penalties up to $50,000. What I also think this is extremely important, why you test at tenancy changes. You test it's clean when people go in, you test it on exit. If it's not clean, you know who's to blame. So there's a lot to digest there, but the $7,200 liability for failing to disclose results within 7 days, that really stands out. And this isn't something you can just put on the to-do list for next week. You need to do it.
Exactly. The regulation puts the responsibility squarely on the landlord to be proactive. I also think the rules around furnishings are really clear now. If you've provided a mattress or a couch and it's in a contaminated area, you can't just clean it. It has to be disposed of. But great news that you no longer necessarily need to replace all the carpets and curtains now, which used to be a blanket rule. Soft furnishings couldn't be decontaminated. So this is really good news.
The room by room rule is a massive improvement as well. It stops the entire house being written off, because if it is only one area that has a high reading, we can decontaminate that. But remember, part of the home that hits 30 micrograms in uninhabitable mark, the notice period for the end of the tenancies are very short.
It's also important to note that tenants aren't required to move out during decontamination unless it's uninhabitable. But you should discuss relocation and rent reductions and get it in writing. This is all about professional communication. So if you've got a property manager, make sure they're all over this.
So for any landlords listening, please check the link below for the description to see the full guidelines. Being compliant isn't just about avoiding that $50,000 penalty. It's about providing a safe home.
Absolutely. So segment 3 for today, from migration and tourism, adding a new twist. Finally, we're looking at the latest migration and tourism figures. ASB's released a report showing that migration momentum remained strong through February, and it's actually running ahead of what the Reserve Bank had penciled in.
This is a significant twist to the outlook for housing. More people coming in means more demand for housing, but it has also complicated impact on inflation and interest rates. So let's break that data down.
ASB economist Wesley Tanavasa noted that annual net immigration sat around 25,000 in the year to February, with short-term permanent and long-term inflows running at about 43,000 a year. This pace is stronger than the Reserve Bank's most recent working age population forecasts, suggesting that the labour force is rebuilding more quickly than policymakers expected.
A key shift is that Kiwi flight looks to have peaked. Fewer New Zealanders are heading offshore, while arrivals from China, India, and Asian countries are increasing. And a lot of people that we know and kids of people we know that went to Australia are coming back because with $1.3 million as a average house price in Melbourne, $1.7 million in Sydney, it's just unaffordable. Tourism is also surging, with short-term visitors arriving, reaching 92% of pre-COVID peaks. Chinese arrivals have tripled recently on the back of the Lunar New Year, and ASB emphasizes a two-sided effect. While more workers can ease wage inflation, faster population growth lifts demand for housing and everyday spending, which could keep mortgage rates higher for a bit longer.
That safe haven comment in the ASB report's really interesting. With global tensions in the Middle East, it seems that some Kiwis are delaying their overseas experience and staying home instead. And also, potentially we'll start seeing people from other parts of the world as well, looking at New Zealand as being a safe haven to move to as well. And it makes total sense. If Kiwi flight has peaked and more people are staying, that's a lot of unexpected demand hitting the housing market. When you combine that with the tourism recovery reaching 92% of pre-COVID levels, the pressure on accommodation, especially in the regional markets, is looking like it will only go one way, and that's up.
Exactly. And that is this tug of war that the Reserve Bank is dealing with. In one hand, more workers will help to fill those hospitality, construction jobs, which eases wages pressure. But on the other hand, those 43,000 new arrivals every year need somewhere to live.
And this is why we keep seeing those higher for longer warnings on mortgage rates. If population growth keeps pushing up demand for housing and spending, inflation could be harder to kill.
It really reinforces why you can't just wait for rates to drop before you make a move. You have to look at the supply and demand and the fundamentals and know your fundamentals. If migration is stronger than expected, that's a long-term tailwind for property values. I suspect it won't take long before any pockets of potential oversupply are soon mopped up and we're back into a seller's market rather than a buyer's market, especially after the election.
Yeah, and I think this is the perfect buyer's market at the moment. So like I keep saying, the clue's in the name. There's plenty of properties on the market at the moment, not as much competition from other buyers, especially since the war in Iran. So yeah, this is the time to get out there. When everyone else is sitting on the sidelines running scared, this is your opportunity to zig when everyone else is zagging.
But it's got to fit your financial position. And of course, that's what we help clients with. So that wraps up episode 11 of New Zealand Property Insight. We've covered a lot today, from the shifting home ownership map, the brand new Meth regulations, and also the strength of migration.
If this episode made you realize that you might need a better handle on these compliance changes, or you want to learn how to identify the next growth corridor, or anything else that we've talked about in today piques your interest, we'd love to help you on your journey.
So we run free online events called How to Succeed with Property Investing. It's a really valuable session where we go much deeper into the due diligence, risk management strategies that we've discussed today.
It's completely free and online, so it doesn't matter whereabouts you live in New Zealand. Property Apprentice doesn't sell property, so our only goal is to give you the education and coaching support that you need to succeed, along with financial advice to back that up. You can find the link in the show notes or head to propertyapprentice.co.nz to register.
Thanks for listening, and we'll see you next time.
Keep learning and invest wisely. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.